They always ask me how to get rich. Almost nobody asks how not to lose money. That's the difference between the smart and the merely eager. The eager ones want shortcuts. The smart ones want survival. I've been around long enough to know you don't need to be brilliant to make money. You just need to avoid being stupid. And stupidity, unfortunately, never goes out of style. People forget that losing money is much easier than making it. All it takes is one bad decision, a little arrogance, a touch of envy, and the compounding you worked for 30 years evaporates in 30 days. Warren and I have a rule that sounds simple but is damn near sacred. Rule number 1, never lose money. Rule number 2, never forget rule number 1. It's not a joke. It's not a slogan. It's a survival code. The first time I heard it, it sounded overly cautious. But I've lived long enough to realize it's the only way anyone stays rich. Let me tell you something about risk. Most people think of it as numbers, volatility, beta, charts and ratios dreamed up by academics who've never missed a mortgage payment. That's not risk. Risk is waking up one morning and realizing you've destroyed your own financial future because you borrowed too much, speculated too soon, or trusted too easily. In the 1970s, plenty of smart men went broke chasing easy money, oil stocks, real estate bubbles, penny shares that were supposed to be the next big thing. All ended the same way, tears and tax write-offs. It wasn't that they didn't understand math. It's that they didn't understand themselves. They couldn't resist the urge to look smart, to act before thinking, to chase what everyone else was chasing. That's how you lose money. Not from ignorance, from ego. If you study history, you'll see this pattern repeat endlessly. In 1929, people thought the stock market could only go up. In 2008, they thought housing prices could only go up. Today, they think technology can only go up. Different costumes, same stupidity. The problem is, people don't want slow wealth. They want it fast. And fast wealth rarely sticks. Compounding is slow. Patience feels boring. But losing money, that's exciting. It's thrilling. It's also final. When we say never lose money, we're not talking about never taking a hit on a stock. We've had losers, plenty, but we never bet the farm. We never risk ruin. We never let ego or excitement override arithmetic, because once you lose half your capital, you don't need to make 50% to recover. You need to make 100%. That's math most people never internalize. So the game isn't to swing for home runs. It's to stay in the game. Keep your capital intact. Avoid stupidity like your life depends on it, because it does. The trouble is, avoiding stupidity isn't sexy. No one throws a party for didn't go bankrupt this year. But that's the quiet truth of compounding. It rewards the survivor, not the gambler. When I look back at my life, the biggest gains didn't come from brilliant insights. They came from avoiding disasters, not buying overpriced garbage, not partnering with crooks, not trusting people who said, trust me. That you survive long enough and opportunity finds you, but if you blow up early, you don't live to see it. That's what never lose money really means. It means discipline when everyone's drunk on optimism. It means saying no far more than you say yes. It means sitting on cash when everyone else is bragging about their latest stock pick. There's a saying in poker, you don't have to win every hand, just don't go broke. Investing's the same. You don't have to be a genius. You just can't afford to be a fool. And believe me, the world is full of fools with fancy degrees. So when people ask for my best investment advice, I tell them this: forget about making millions. First, learn how not to lose thousands. You do that consistently for a few decades, and you'll be surprised how rich you become by simply refusing to be stupid. Because in the long run, the market rewards the rational and destroys the careless. That's rule number one. And if you truly understand it, you'll never need another. If you want to understand why people lose money, you don't start with finance textbooks. You start with human nature. The real enemy of wealth isn't inflation or taxes. It's emotion, fear, greed, envy, the holy trinity of financial destruction. Each one has wiped out more fortunes than any market crash ever could. People don't lose money because they can't calculate. They lose because they can't control themselves. You can teach a man discounted cash flow. You can't teach him not to panic when the ticker turns red. During the Great Depression, I saw grown men cry over falling stock prices. And decades later, I watched their grandchildren repeat the same behavior. Different generationsarmbewaring. The human brain hasn't evolved for rational investing. It evolved for survival. Fight, flight, or follow the herd. Useful in the jungle, disastrous in the market. Most investors don't even realize they're emotional. They call it intuition or gut feel. But what it really is primitive impulse dressed up as insight. Every time there's a boom, optimism becomes a drug. And like all drugs, it feels good until it doesn't. The tech bubble of 1999, pura euphoria. People quit their jobs to day trade internet stocks that had no profits and no business models. The madness was so thick you could smell it in the air. When the crash came, everyone said the same thing. No one could have seen this coming. Of course we could. It was obvious to anyone not high on greed. And then there's fear, the flip side of the same coin. When markets fall, people suddenly want to sell everything. That's like jumping out of a plane because you don't like turbulence. In 1974, during the oil crisis, stocks were dirt cheap. But nobody wanted them. They wanted safety, cash, bonds, anything that felt secure. Meanwhile, the real safety was in buying great businesses at bargain prices. Fear made them blind. That's the psychology of losing money. You buy high because you feel good. You sell low because you feel scared. Then you call it bad luck. It's not bad luck. It's bad wiring. And envy, that's the worst of all. People can live with being poor. They can't stand being poorer than their neighbor. You see a friend double his money in crypto or meme stocks, and suddenly your own portfolio looks small. So you jump in late because you can't bear to be left out. That's how bubbles are built, one envious fool at a time. Envy is the tax the stupid pay to the clever. It's also the easiest one to avoid if you have the discipline to stay in your own lane. You see, the market isn't designed to make you rich. It's designed to expose your weaknesses. And most people are walking around with emotional open wounds. They think the problem is the market. No, the problem is the mirror. If you can't stand to watch your stocks fall without losing your mind, you have no business owning them. If you can't resist following the crowd will eventually lead you off a cliff. That's why Warren and I built our system on temperament, not intelligence. Temperament is underrated because it's boring. You can't put it in a spreadsheet, but it's what keeps you rich when the world goes mad. Remember this: the market is a machine built to transfer money from the impatient to the patient. That's not poetry, that's arithmetic. The impatient investor trades on emotion. The patient investor acts on logic. One ends up broke, the other ends up wealthy and bored. And boredom, by the way, is one of the greatest advantages you can have. If you can sit still while everyone else is panicking, you'll own their assets soon enough. So the next time your hands itch to trade, ask yourself, am I making a rational decision or just trying to feel smart, special, or safe? Because behind every financial disaster, there's usually a perfectly normal person who couldn't stand to do nothing. That's how money is lost. slowly, quietly, emotionally, not through ignorance, but through the inability to sit still. Most people don't lose money chasing risk. They lose it chasing safety. That's the great irony of investing. The more people crave comfort, the more danger they walk into. Safety feels good. That's why it sells. Wall Street knows it. Advertisers know it. Even politicians know it. People want to believe there's such a thing as a guaranteed return. They want someone to say, "You'll be fine, just trust me." That phrase, "just trust me," has bankrupted more people than recessions ever did. In my early years, I watched plenty of so-called safe bets implode. Municipal bonds that defaulted, blue chip companies that turned into roadkill, real estate that never recovered, and of course, the infamous diversified funds that were neither diversified nor funds worth owning. Just marketing dressed up as prudence. The illusion of safety is built on two pillars: ignorance and comfort. Ignorance because people think stability equals safety. Comfort because they prefer a pleasant story over a hard truth. A stable price doesn't mean a safe investment. Ask anyone who owned Lehman Brothers in 2008. It looked solid until it wasn't. There's a difference between what feels safe and what is safe. Cash feels safe until inflation eats it alive. Bonds feel safe until interest rates rise. Housing feels safe until the bubble bursts. Everything looks safe when you stop asking questions. That's why most investors get blindsided. They stop being curious once something looks familiar. I've always said, it's not supposed to be easy. If it were, dumb people would do it and still win. But safety seekers want it easy. They want comfort, certainty, reassurance. And the world is more than happy to sell it to them. When interest rates were near zero, people said, well, bonds are safe. Real estate always goes up low. Then they borrowed at record highs and bought inflated assets. A few years later, they learned the oldest rule in finance. When everyone feels safe, that's when it's dangerous.